Welcome to the Deep Dive. Today, we are strapping in to analyze one of the most remarkable and frankly complex stories in modern banking history. I'm talking about the transformation of First Citizens Bank shares, ticker FCNCA.
Right. This is an institution that didn't just, survive the 2023 banking turmoil. They capitalized on it.
Absolutely. Executing what many are calling a generational arbitrage by acquiring the fallen Silicon Valley Bank at, well, fire sale prices.
To put it mildly.
Our mission today is explicitly quantitative and is driven by your comprehensive investment analysis. We are going to go beyond the headline noise.
We have to.
We need to cut through the smoke and mirrors created by purchase accounting rules, look past the oft misleading gap earnings, and really determine if FCNCA is the rare compounder that the most sophisticated investors believe it to be.
Or if that lingering market skepticism, that complexity discount, is actually justified.
Exactly. And for us, this entire deep dive is laser focused on one single metric.
The sustainable high-velocity drivers of tangible book value growth, TBV.
That's the whole game here.
It is. That focus on TDV is this necessary intellectual starting point. FCNCA is not a bank whose success you can judge on quarterly EPS alone.
No.
It's a strategic vehicle. It's designed for long-term compounding of intrinsic value, and often that comes at the expense of short-term EPS predictability.
And they are moving fast.
Very fast. You have the landmark SVB acquisition in March 2023, which really defined its scale and opportunity.
And then, much more recently, the strategic decision to acquire those 138 branches from BMO Bank.
Right, in late 2025, and that really defines their current strategic pivot.
So we aren't studying a conservative regional bank anymore, even though that's its roots.
Not at all.
Right.
You're analyzing an institution at a critical strategic inflection point.
Okay, so break that down for us.
The narrative really breaks down into two distinct phases. Phase 1, post-SVB, was pure defensive integration.
Stabilize the ship.
Exactly. Stabilize that enormous specialized SVB franchise, mitigate the fears of catastrophic deposit flight, and, accurately execute the credit marks. Now, with the SVB assets largely de-risked and integrated, they are shifting entirely to offense.
And the BMO deal is the proof.
It's the clearest proof of that.
Shifting to offense in what way, specifically?
In optimizing their funding structure. It's that simple. SVB gave them high-yield, specialized assets.
Right.
The BMO deal gives them cheap, sticky core funding.
The other side of the balance sheet.
The core thesis here, and what our critical investor must watch, is whether the holding family's unique capital allocation can successfully translate this complex inorganic growth. The high-yield assets combined with low-cost liabilities into a superior, sustainable return on equity.
And superior TBV growth.
That's the end goal. We need to see alignment across the board, from governance all the way down to the individual niche lending segments.
Okay, let's unpack that governance structure first, because before we even look at the balance sheet, we have to understand the philosophy driving the decisions. Your source material frames this as an empire builder moat.
I think that's the right way to look at it.
A system designed for long-term power and expansion. So what fundamentally differentiates FCNCA from a standard publicly traded regional bank like say, a KeyCorp or a Comerica?
It boils down to a fundamental misalignment between FCNCA and really the rest of the publicly traded financial sector.
Oh, so?
FCNCA operates under the effective, unchallengeable control of the holding family. They're descendants of the bank's founder. And they maintain this power through a dual-class share structure, which is the cornerstone of that moat.
Right. The Class A and Class B?
Specifically, their Class B shares hold 16 times the voting power of the Class A shares that you trade publicly on the NASDAQ.
16 to 1. That's an extraordinary leverage ratio in terms of corporate control.
It is.
So what's the practical implication of that for a stock market investor like you?
It means insulating management, primarily CEO Frank B. Holding Jr., from the tyranny of short-term Wall Street pressure.
And activists.
And activist shareholders, absolutely. When a standard public bank makes a risky acquisition that results in short-term earnings volatility, their CEO immediately faces calls for resignation or a board shakeup.
Sure.
FCNCA management is fundamentally protected from that kind of noise.
And that shield allows them to do what?
To pursue a counter-cyclical, high-risk, high-reward strategic acquisition strategy. They can essentially wait for crises, knowing they have the capital and the governance structure to swoop in when others are terrified.
That's the key, the countercyclical strategy. We saw it with CIT Group back in 2020, 2021.
Bringing in those specialized commercial assets?
And then most dramatically with SVB in 2023. This is a strategy built on capitalizing on maximum market stress, not avoiding it.
Exactly.
But how do we know, beyond just the structural control, that the family's interests are truly aligned with us minority Class A shareholders who are just looking for capital appreciation?
That's a fair and critical question.
Yeah.
For any sophisticated investor looking at a controlled entity, you have to ask that.
So what's the evidence?
We look for concrete evidence of alignment. And the strongest proof is management's personal capital commitment. Frank B. Holding Jr. is not just an executive. He is a major shareholder.
Skin in the game.
A lot of it. And your sources meticulously track consistent insider buying. Specifically, he purchased over $2.6 million worth of shares in the 24 months leading up to the end of 2025.
And what's particularly striking about that is the timing.
Absolutely. The documents highlight a purchase of $220,000 worth of stock as recently as November 2025.
After the stock had already run up over 250% since the SVB deal.
Exactly. When an owner-operator is consistently putting fresh capital to work at escalating valuations, it signals supreme confidence.
He's not selling into the rally, he's buying.
It tells you they believe the intrinsic value, the compounding TBV, is still materially disconnected from the current share price, despite that massive rally. This means the primary goal, their North Star, remains tangible book value growth.
Not hitting the analyst consensus EPS target next quarter.
Precise.
So if we accept that this governance moat defines the operational philosophy, we can't really call FCNCA a regional bank anymore.
No, the regional bank label is functionally obsolete for FCNCA.
So what is it?
It is fundamentally a growth by acquisition machine. You should think of it as a multi-strategy holding company wrapped in a bank charter.
Okay.
The legacy General Bank in the Carolinas, that provides a stable, low-growth, core cash cow. That's what funds the high-growth, high-yield expansion segments.
And the real value creation, the alpha, comes from?
It comes entirely from the acquired niche segments, CIT's rail finance and SVB's venture banking ecosystem. The mandate from the top is clear. Prioritize inorganic opportunities and drive TDV per share.
And the numbers show it's working.
Your sources confirm this strategy is mathematically delivering. It shows TBV per share growing at an impressive 8.2% year-over-year in Q3 2025.
That's solid compounding for a bank of this size.
Very solid.
And crucially, that 8.2% is just the organic growth before we even factor in the mechanical boost from the aggressive share buybacks.
Which is a huge part of the story we'll get to.
So we have an insulated owner-operator governance structure dedicated to long-term compounding, now fueled by a massive acquisition.
This brings us to the core event. The entire valuation thesis for FCNCA hinges on the success of the Silicon Valley Bank acquisition. This wasn't just big. It was secured during a moment of maximum fear.
Which translates into maximum long-term value. Let's detail the scale of that generational arbitrage. We hear the headlines, but the numbers really bear repeating.
The scale was breathtaking, especially relative to FCNCA's size at the time. On March 27, 2023, FCNCA acquired approximately $110 billion in assets and assumed $56 billion in deposits.
And FCNCA's market cap was what, maybe $9 billion a few years before that?
Something like that. It was a minnow swallowing a whale. But the absolute critical number is the discount.
The $16.5 billion.
A staggering $16.5 billion markdown on the acquired assets.
That discount, 16.5, that's essentially an instant injection of equity. It didn't just feel good. It immediately doubled FCNCA's entire equity base overnight, didn't it?
It created an immediate capital fortress. That's the best way to describe it. That enormous discount functioned as the ultimate absorption buffer. It absorbed all the necessary fair value accounting marks on the acquired loan and securities portfolio.
So they didn't have to worry about the mark-to-market fluctuations in the bond portfolio that were crushing other regionals.
Crushing them. They got a clean slate. They essentially bought a massive asset base for a fraction of its carrying value, giving them a monumental advantage in capital safety and insulation.
However, initially, that SVB deal came with a massive perceived tail risk.
Of course.
The assets were specialized, tied to the volatile VC ecosystem, and the deposit base was famous for its concentration risk. That's what triggered the run in the first place.
It was.
Which is why the termination of the loss share agreement is arguably the single most important de-risking event. Tell us about that April 7, 2025 milestone.
This is the pivotal proof point. This is what allows the market to re-rate the credit risk of FCNCA. Initially, the FDIC had provided a backstop, right? They agreed to cover 50% of the commercial loan losses that exceeded a $5 billion threshold.
That provided comfort, but it also put a stigma on the assets.
Exactly. The implication was that they were too toxic to manage alone.
But just over 2 years later, they terminated it. Why is that so definitive?
Well, the mutual termination of the shared loss agreement signals management's supreme quantified confidence for FCNCA to willingly give up a 50% insurance policy.
It means their internal models must show losses are highly unlikely to ever hit that $5 billion trigger.
Precisely. They are telling the market, we know these assets, the credit marks we applied at acquisition were sufficient, and we don't need the FDIC's guarantee anymore.
And the benefits go beyond just risk perception.
Absolutely. It cleans up the administrative burden. The bank no longer needs to constantly report granular loss ratios to the FDIC. That saves massive compliance and admin costs.
So the SVB loan book is now fully integrated.
Fully integrated and fully underwritten by FCNCA's own risk management framework. For a critical investor, this event removes a huge layer of integration uncertainty.
Okay, let's address the initial bear thesis, which focused relentlessly on the deposit flight narrative.
Right, the hot money argument.
Conventional wisdom held that SVB's deposits were flighty, concentrated, and would abandon this conservative Carolinas-based owner. What does the data, particularly from Q3 2025, tell us about the stickiness of that SVB client base?
The data decisively refutes the flight thesis. It's a major victory for the integration team. The SVB commercial segment didn't just stabilize deposits, it actually grew them by an impressive $2.09 billion in Q3 2025 alone.
So they're not just retaining clients, they're winning new ones.
That's what the data says. The franchise is still growing.
And perhaps more importantly than the volume is the quality of those deposits. I'm talking about non-interest bearing or NIB.
That's the core competitive advantage. Despite the overall industry trend toward interest-bearing accounts due to higher rates, FCNCA's NIB deposits remain robust at 26.2% of total deposits.
And that's substantially higher than most regional peers.
Far higher. Many are struggling to keep NIB above 20%.
So why does that 26.2% NIB figure matter so much to the bottom line?
Because NIB deposits are essentially free funding. They generate zero interest expense.
And the stickiness suggests?
What? It suggests that the integrated treasury management services that SVB provided to its tech, life sciences, and VC clients are a durable moat. These aren't just savings accounts. They're the operating accounts necessary for running payroll, managing cash burn, executing complex global payments.
So the switching costs are just too high.
The administrative headache and risk of disrupting critical financial infrastructure, it's just too high for most founders to move, especially now that the new parent company, FCNCA, has demonstrated stability.
The brand is intact.
The SVB brand cachet, operating as the specialized division of FCNCA, is fully intact and continuing to deliver.
So, synthesizing the value creation here, the governance moat allowed the fire sale purchase.
The $16.5 billion discount created the immediate capital buffer.
The loss share termination de-risked the credit.
And the deposit data confirms the franchise viability.
The result, shares up over 250% since the acquisition, and TBV per share grew 8.2% year-over-year to $1,629 in Q3 2025.
That is compounding at a rate few peers can match. And that compounding rate is a reflection of the high-quality assets they acquired and integrated.
Right. We have to stop viewing FCNCA as a bank that relies on commodity lending.
Its competitive edge is entirely housed within its specialized commercial verticals, where expertise commands a premium on yields and pricing power.
And we see that immediately in the asset yields. FCNCA's yield on interest-earning assets was 5.64% in Q3 2025.
That's a full 50 to 70 basis points higher than many generalist super-regional banks.
That gap is the specialty moat in action.
Precisely. They are trading complexity for yield. Let's detail the two primary engines driving this.
Okay.
First, we have Global Fund Banking, or GFB. This is the crown jewel of the SVB acquisition. A premier global lender for capital call lines directed toward private equity and venture capital funds.
We need to unpack GFB because the risk profile is often misunderstood. It's not lending directly to risky startups.
Correct. It's lending to the funds themselves. The capital call line functions as short-term bridge financing.
So how does that work?
When a PE or VC fund needs to quickly deploy cash for an investment, they draw on the line. Then a few weeks later, they execute a capital call against their limited partners, the LPs,
Endowments, pensions.
endowments, pensions, sovereign wealth funds, to repay the debt. Crucially, the loans are guaranteed by the uncalled capital commitments of those LPs, who are typically investment-grade institutions.
That makes the credit risk almost negligible, doesn't it?
Historically, yes. Even in severe downturns, the loss rates on these specific capital call lines have been near zero because the LPs are contractually obligated to fund the call.
So there was aggressive competitive poaching after the crisis, HSBC, for example. How did FCNCA defend this core asset?
They succeeded by proving that the moat wasn't just the people. It was the entire integrated platform and network effect.
It's sticky.
Very sticky. VC funds operate on speed and trust. Moving their entire banking platform, which includes complex KYCML, international currency transfers, and treasury integrations, is immensely difficult.
And the proof is in the number.
The proof is GFB loans growing 10% sequentially in Q3 2025. That growth proves the network effect is alive and well.
What remains the inherent vulnerability then?
Concentration risk. The portfolio is heavily weighted toward tech, life sciences, and healthcare, and the growth of the business is highly sensitive to the overall VC deployment cycle.
So a VC winter could slow things down.
It could slow future growth rates, though not necessarily immediate credit quality.
Now, let's pivot from Silicon Valley to 19th century infrastructure. Rail finance, the legacy asset from the CIT acquisition.
It's a great contrast.
It's almost funny to think of the same bank lending to hypergrowth startups and simultaneously financing heavy-duty rail cars. It is a true Frankenstein's bank.
It is, and that cultural complexity is precisely what the market applies a discount for.
Yeah.
But structurally, rail finance is a brilliant, countercyclical, low-volatility asset.
It's an oligopoly.
A high-barrier oligopoly. FCNCA is one of the top lessors of rail cars in North America.
And what are those barriers to entry?
You need massive, long-term capital, technical expertise on maintenance cycles, and long-term contracts with the big Class I railroads. Generalist banks simply cannot replicate this. The economics are fantastic.
High margin, inflation hedged.
Exactly. High margin, consistent inflation hedged returns through long-term lease structures.
And how does that impact the bank's revenue structure?
It generates a distinct, non-interest income stream, which provides valuable diversification away from purely interest rate dependent lending. It's an annuity-like revenue generator.
Any caveats?
The one caveat, as we saw in Q3 2025, is that this stream can be lumpy due to required maintenance costs on the aging railcar fleet. But overall, utilization rates consistently hover above 96%.
So these two niches, GFB and rail, are the bedrock that generates their superior core earnings?
That's right.
But if the specialized niches are the engine, then purchase accounting is the required complexity that shields the engine from view.
That's a great way to put it.
For any sophisticated investor, understanding purchase accounting accretion, or PAA, is crucial to accurately modeling FCNCA's true profitability.
It absolutely is. PAA is the single biggest factor distorting the reported earnings.
Explain the mechanism.
When FCNCA acquired those assets at that massive discount, they marked the loans down to their fair value. That difference, the accretable yield, is not a cash gain. It's recognized as additional net interest income over the life of the loans.
So it makes the reported NII and net interest margin look artificially inflated.
Exactly.
Let's quantify that distortion using the Q3 2025 results. This is where we need to get granular for you.
Okay. In Q3 2025, the reported NIM was 3.26%.
But the core NIM, stripping out PAA,
was 3.15%. That 11 basis point difference represents about $44 million in NII for the quarter.
Now, that $44 million is a real cash flow benefit that helps build capital.
It is, but it is mathematically finite. It's a temporary tailwind.
What's the timeline for that PAA tailwind to diminish?
Management guidance, which is generally reliable here, suggests that the PAA benefit will start to burn down materially within the next 2 to 3 years. By late 2027, maybe 70% of it will be gone.
So the investor insight here must be to strip out that noise completely when valuing the bank.
Precisely. You have to value the bank based on the core 3.15% NI.
But the critical takeaway isn't the noise, it's the underlying quality.
That's the key. Even that core 3.15% NIM is superior to the average super-regional peer, which often hovers closer to 3%. The structural advantage from the high-yielding SVB and CIT loans is real and persistent.
Okay, let's pivot to cost discipline. FCNCA's 56.78% adjusted efficiency ratio is impressive.
It really is.
It suggests that despite the weird map complexity of integrating multiple platforms, they are running a much leaner operation than larger peers like PNC and Truist.
Both of whom are sitting around 63%.
So what does that tell you?
It's a testament to management's ruthless focus on synergy realization. They were extremely effective in eliminating redundant back-office functions, IT, HR, compliance from both SVB and CIT.
They kept the rainmakers and cut the overhead.
They maintained the revenue-generating specialty bankers while aggressively shedding excess overhead. That ratio is a core strength.
But let's look at the flip side. Return on equity. The bank's headline ROE of 10.62% appears suppressed compared to a peer like Fifth Third, which is closer to 13.4. Why?
This is the second crucial mathematical artifact, the capital drag. FCNCA is running a fortress balance sheet, and that intentionally suppresses the ROE.
How so?
Their Common Equity Tier 1, or CET1 ratio, is a highly conservative 11.65%. This is significantly higher than the peer average for banks of their size.
Who are closer to 10.6%.
Or even lower. So by carrying an extra 100 basis points of equity relative to peers, they are spreading the same level of net income over a much larger denominator. The ROE is mathematically penalized.
But if they were to leverage down to the peer average?
If they leverage down to a 10.6% CET1, their reported ROE would mathematically climb well past 13%, maybe approaching 14%.
So the suppressed ROE is not a sign of poor earning power, but a sign of strategic overcapitalization?
Exactly. They have built an optionality machine. That excess capital is latent earning power.
Finally, let's address asset quality, starting with that headline, NCO spike. The net charge-off ratio jumped to 0.65% in Q3 2025, which looks alarming.
It sounds alarming, but it requires deep context. The spike was entirely driven by one single idiosyncratic event.
A single loan.
An $82 million charge-off related to one specific supply chain finance client, identified as First Brands within the legacy commercial bank. This was an isolated credit event.
Not a systemic failure in the SVB or rail portfolios.
Not at all. If you strip out that singular $82 million charge-off, the NCO ratio falls dramatically to about 0.42%.
And 0.42% is consistent with, or even better than, many peer averages.
It is, but we must also address the other side of asset quality, the perceived low allowance for credit losses. FCNCA's ACL is 1.14%, much lower than PNC's 1.61.
This is where the hidden reserves come into play.
It's purely an accounting mechanism resulting from the fair value marks. Because the acquired SVB and CIT loans were marked down so severely at the acquisition, remember that $16.5 billion discount.
That created a preloaded loss absorption layer.
Exactly. Think of it as paying a massive upfront insurance premium. So the statutory ACL just doesn't need to be as high as a peer bank that organically originated its entire portfolio.
Okay, we've established the governance, the SVB arbitrage, and the true core profitability. Now we look forward. The BMO Bank branch acquisition, announced in October 2025, is the first clear signal of that offensive pivot.
It's an absolute masterclass in tactical M&A. This was not an acquisition driven by loan growth. They acquired 138 branches, but only $1.1 billion in associated loans.
This was a pure funding play.
That's exactly right. FCNCA acquired $5.7 billion in granular low-cost deposits.
At what cost?
The weighted average cost of these newly acquired deposits is a highly attractive 1.43%. Compare that to their wholesale funding sources, like FHLB advances, which can hover around 5%.
So this is a direct structural solution to the primary weakness exposed during the 2023 crisis.
Absolutely. They're replacing expensive, volatile institutional funding with cheap, stable retail deposits. This fundamentally improves their NIM profile moving forward.
But speaking of that footprint, this brings up the most pressing investor concern, the famous weird map question.
Right.
FCNCA is now a community bank in the Carolinas, a national rail lessor, a Silicon Valley venture lender, and a Midwest retail network. Doesn't that sheer complexity justify the current market discount?
That is the highest level risk that keeps the valuation multiple suppressed, and it demands scrutiny.
The operational challenges must be immense.
They are. They're integrating at least 4 distinct core banking platforms: SVB's cloud-native tech, CIT's legacy systems, the Carolinas Bank, and now BMO's branch tech. And beyond that, they must manage fundamentally disparate corporate cultures.
Merging Silicon Valley's speed with a conservative Carolina bank.
It's not easy. The market applies a complexity discount because running a sprawling empire is inherently harder and less predictable than running a clean, homogeneous regional franchise.
So how do we conclude this complexity is manageable rather than a slow-burning disaster?
We look back at the evidence. They've executed two massive integrations, CIT and SVB, in rapid succession while improving their efficiency ratio.
To 56.78%.
Management is proving they can manage this complexity effectively, but the discount will persist until they prove they can integrate Biome and fight another major headwind, regulatory costs.
Which brings us to the necessary evil. The Category P regulatory burden.
Crossing that $100 billion asset threshold in 2023 wasn't just a badge of honor. It imposed permanent, non-trivial costs.
That is the crucial headwind for operating leverage moving into 2026.
It is. Category 4 status means FCNCA is now subject to far stricter regulatory oversight. They face mandatory CCR stress testing starting in 2026, enhanced liquidity requirements.
So more staff, more tech, more compliance.
Significant permanent enhancement. It means that every time they realize a synergy saving, they are immediately fighting structural inflation in non-interest expense driven by regulation.
So that mid-50s efficiency target might be a stretch?
It acts as a structural drag that could easily keep the ratio permanently closer to the high 50s. This is a cost baked into the business model now.
Finally, we have to touch on the vulnerability relevant across the entire sector, commercial real estate. FCNCA holds $20 billion in CRE exposure.
14.9% of total loans. That's manageable. Many peers are well into the 20s.
And they've mitigated the highest risk segment.
General office exposure is very low, less than 2% of the total portfolio. That's a substantial defensive position.
Where, then, does the remaining vulnerability lie within the non-office CRE book?
The pressure point is less about outright defaults and more about refinancing risk in 2026 and 2027.
The maturity wall.
Exactly. Many legacy loans, originated when rates were near zero, are coming up for maturity. As those borrowers attempt to refinance at current interest rates, the debt service coverage ratios come under intense pressure.
And that forces the bank to build reserves or take non-accruals.
Even on good collateral.
Yeah.
It's a sector-wide slowdown, and FCNCA cannot entirely escape it.
This careful navigation of risk leads us to what many sophisticated investors view as the ultimate driver of the valuation thesis: the aggressive capital allocation.
The cannibal buyback strategy.
They operate more like a private equity firm, viewing their own stock as the best available acquisition.
That's the core philosophy. When you combine superior capital generation, that 11.65% CET1 ratio, with a stock trading at a depressed multiple, buying back shares becomes mathematically the highest return on investment available.
He's doing M&A on his own stock.
Exactly.
Let's look at the velocity and volume. Since July 2024, they've repurchased a staggering $4 billion in shares.
Retiring over 15% of the Class A float in under 18 months. This is not a token buyback.
It's an annihilation of outstanding shares.
It is. They repurchased $900 million worth of stock in Q3 2025 alone. This tells you management believe the internal rate of return on buying their own stock at 1.3 times tangible book value far exceeds any other opportunity.
But let me challenge that. The stock just ran up 250%. If they're a capital fortress, why not hoard the capital for the next crisis, the next fire sale M&A, instead of buying back stock that just ran up?
That's the critical question. The answer lies in the certainty and the math. The market is offering them a guaranteed, mechanically accretive return now.
Explain that.
When they retire stock at 1.3 times TBV, they're immediately increasing the TBV per share for every single remaining shareholder. It's a guaranteed return. Waiting for the next crisis carries high uncertainty about timing, price, and regulatory approval. This buyback program acts as a turbocharger, mechanically translating core earnings into double-digit per share TBV growth.
And this perfectly explains the bank's notably low dividend yield.
Around 0.4%.
That's deliberate.
It's a deliberate, tax-efficient capital strategy preferred by the owner-operators. Dividends are tax inefficient. The holding family prefers tax-efficient capital appreciation realized through TBV growth and shrinking the share count.
It's the definition of capital allocation discipline in alignment with long-term owner goals.
Absolutely.
Okay, now we synthesize this entire analysis to determine if the current market valuation makes sense.
We can use the valuation metrics from your table too. We've established superior core profitability, superior capital, and a proven integration record. Yet FCNCA trades at a stark discount.
At late 2025, about 1.31 times price to tangible book and 11.8 times forward PE.
And when you compare that to high-quality peers, the gap is glaring. BNC trades around 1.66 times PTBV, Fifth Third closer to 1.85,
So the market is applying a substantial persistent discount.
for the reasons we dissected. The dual-class structure, the complexity and noise from PAA and integrations, and the residual risk perception.
The core investment argument then becomes, is that discount warranted?
Our analysis suggests it's heavily unwarranted. The bank is generating superior core income, is demonstrably efficient, and has an unassailable capital fortress. When you layer in the multi-billion-dollar buyback, the current valuation opportunity becomes highly asymmetric.
Okay, let's leave our listener the intrinsic value scenarios, starting with the downside floor. What does the bear case look like?
The bear case floor assumes a worst-case scenario. CRE blows up, new credit losses materialize, margins compress, and it G-rates to historic trough valuations.
Yeah.
Applying a very conservative 1.1 times PTBV multiple to a slightly higher 2026 TBV estimate of $1,750 suggests a potential retracement to roughly $1,925.
Which is limited downside from the current price, protected by that fortress balance sheet.
The capital base provides a clear floor.
Now for the base case target, assuming smooth integration and stable core earnings.
The base case assumes core ROE stabilizes in the 11 to 12% range, and TBV grows at 10% annually, driven by earnings and buybacks. Applying a conservative but slightly higher 1.4 times BTBV multiple yields a price target of approximately $2,600.
Wait, let's stop there. That base case multiple of 1.4 is still substantially below peers like PNC.
It is.
So the difference between 2,600 and the high-end scenario must therefore be purely multiple expansion, no additional earnings growth required.
That's the entire point. That gap, the potential $440 price difference between the base and bull cases, is the asymmetric reward for the complexity risk fading.
Which leads us to the bull case target. What happens if the market fully acknowledges the quality?
In the bull case, integration risks fade, PAA noise becomes negligible, and the market re-rates FCNCA to trade at parity with its high-quality peers. If the bank achieves a peer average 1.6 times PTBV multiple on that growing TBV base, the target rises significantly to around $3,040.
So the bulk of the upside is just closing that complexity discount.
And proving that the unique structure, the Empire Builder moat, is worth a premium, not a penalty.
Okay. Let's synthesize.
To synthesize the verdict for our critical investor, FCNCA is an institution that successfully executed a masterstroke acquisition in SVB, creating immense tangible value protected by an 11.65% CET1 capital fortress. The crucial de-risking event, the termination of the FDIC loss share agreement, is already in the rearview mirror,
And they're now on offense.
actively moving to shore up the liability side with the BMO acquisition. FCNCA is fundamentally prioritizing compounding per-share value through aggressive, mathematically certain buybacks, supported by highly resilient, specialized lending niches.
For you, maintaining surveillance on this complex stock is critical. Based on our deep dive, what are the key monitorables for 2026 that will confirm the base case thesis?
4 key items. First, we need successful stabilization and low deposit attrition from the BMO branch integration.
Got it.
Second, we must see sustained double-digit loan growth in the high-velocity global fund banking segment. That's the primary growth engine.
Okay.
Third, confirmation that the Q3 2025 $82 million charge-off was truly idiosyncratic.
Not the start of a trend.
And finally, continued aggressive execution of the $4 billion buyback plan. If they slow that repurchase velocity, the certainty baked into the compounding thesis weakens significantly.
That brings us back to the core governance structure and the complexity discount. If the SVB risks are largely mitigated, core earnings are stabilizing well above peers, and the multi-billion-dollar share buybacks are mathematically certain to drive per-share value growth. What valuation multiple is truly justified for a highly capitalized bank that operates with the long-term discipline and tax efficiency of a private equity fund? That's the question that dictates whether FCNCA ultimately breaks through that complexity barrier and delivers the bull case reward.